Alrighty. You want to kick us off?
You.
I'm
Yeah,
good.
sure. So I'll start us off with a couple of analysis points, and then I'll let you respond to those briefly, see if you have any objection with those, and then I'll move into my main lines of argumentation after that
Oh,
if you don't have any response to those. So I'll start with my first analysis point, which you can write down as analysis one, policy versus public opinion. Again, policy versus public opinion. What we're here to discuss in today's debate round is whether or not the Republican tax plan is good policy, not if the public likes it as a whole. Policy meaning that it's good for people, not necessarily that everyone likes it. There have been plenty of things in the community and good for a country as a whole that, generally speaking, not a lot of people like. That's especially true in public policy. And then my second analysis is that this is a fact res. Again, this is a fact res. And this will really examine how we determine if this is good policy or not. Now, we're not going to be looking at, again, the community as a whole to determine whether or not this is going to be good policy. The way to determine if this is good policy is whether or not the judge, based on our arguments, determines that this is good policy. Affirmative meaning it is, negative meaning that it's not, obviously. So in order to determine if it's good policy, in order for the judge to have a standard or value to determine this, I'm going to be presenting a value for today's debate round. Now, my value for today's debate round is going to be that of fairness. Again, fairness. Whichever side of the resolution can promote the most fair system should be the system that you vote for. With that in mind, let's move into my first background point, and then I'll let you respond to my initial framework, which is the first background point is that what's inside the Republican tax plan. Again, what's inside the Republican tax plan. Now, I'm going to be breaking this down into 8 simple parts. And this is from the initial revision. I haven't actually looked at what they've done. I know that they hand wrote it, parts of it, hand wrote parts of things into the bill like last night or something. I haven't looked at that. I don't even know if they've published that. Based on what they published a couple weeks ago or a month or about a month ago, this is what is going to be inside of the plan. So the biggest part of it is that it's going to be slashing corporate tax rates dramatically from 35% to 20%. The United States currently, before the tax plan being implemented, has some of the highest corporate tax rates in the entire world. Just a couple smaller things underneath this. Individual tax plans change slightly. Higher income earners will receive a slight reprieve in taxes. It reduces medical itemized reductions. It limits mortgage reductions. Executive compensation becomes less deductible. Repeals the Johnson Amendment, which is an amendment that that prevents religious groups from speaking about certain political parties or political affiliations. That this tax plan would repeal that. It also dramatically increases child tax credit, and then another bigger part of it is that it removes state tax deductibility. So the way the current system works right now, I'm pretty sure that you're familiar with it, but for those that aren't familiar with it, the way the current system works right now is that you can deduct income tax, so your state income tax, from your federal taxes. And as I move into my analysis and my points later, I'll be examining why overall that's not a good thing and why the plan itself, removing that, is a good thing. So I'll let you respond to this as a whole, make any adjustments that you want to make, and respond to my framework.
all right, sweet. Yeah, I suppose the first thing is that obviously I'm for the public opinion not really counting because that would just be an appeal to the populace, which doesn't make much sense. The only thing with the fact res, which I'd say is why fairness is a little bit misleading, is because there are lots of like I guess unsavory compromises states have to make when making tax policy. So, for example, I would say it's like the justifications for taxation often seem initially unfair when you say that the government has to take some of your property for this, but it would be more unfair for the government to run in debt and deficit, which in the long run hurts everyone, if that kind of makes sense. So, yeah, so I would say that fairness, I think fairness has to take into account the externalities of not taxing, right? So if it means that the government is running up a massive deficit, that is actually probably more unfair because even though in the short term people might be better off, they're way worse off in the long term. Yeah, the other thing about what's inside the tax. Now, I've got a list of my own, some of which overlapped and some of
Okay.
which wasn't. So the first thing I had, yep, the corporate tax rate going down. That's one we'll definitely talk about. I think another one worth talking about is how the taxation for income earned abroad is going down. Another
Okay.
one would be the adjustment of the namely that the top tax bracket rate is going down. So wait, hang on, the bracket going to 1 million from 470. Yeah, so basically you have to earn more money now before you are hit with the top tax bracket. That's actually doubling. The other thing worth talking about probably is about pass-through income, which is for sole traders and how that's been capped at 20%. The estate tax going away is probably another big one.
Oh yeah,
And
yeah.
then
Sorry, I should have mentioned
yeah,
that.
Yeah, that's right. And all of your and the way they're paying for it, yeah, or at least getting it within the reconciliation budget is all of those slashes of benefits. Which I think the main deductions which were worth talking about were definitely the state and local income tax one. But in general, I'm cool to talk about the other ones, but they seem to be just kind of like nickel and diming themselves into the acceptable bracket. But it might be worth, I guess, because it's a big bill, going through these things one by one and willing to admit when we've actually just hit an agree to disagree point.
Yeah.
So, which one of the things do you think is the most pressing for why you think it's good policy?
Looking at examining, I think now we have 11 things. Obviously, there are some of them that are just kind of like, we can both agree that that's a good or a bad thing. There's some parts of it that are objectively, not okay. Some of them are like objectively good things that, should happen, like the Johnson Amendment. I'm sure we can both agree that's something that should go away. But looking at just the list, I think we're going to talk about corporate tax rates quite a bit. I feel like that's going to be discussed a lot. The estate tax as well. I feel like that is a good thing. Child tax credit being increased dramatically is also a good thing. The state tax deductibility, and then I think I addressed the estate tax as well briefly. So those are the main things that I want to talk about. Most of the bill itself, there's a lot, since it is large. I can't talk about literally everything in the bill, but most of the stuff in it.
Corporate tax rates?
Sorry, what?
Do you want to start with corporate tax rates?
Yeah, that's where I would start. That's actually most of my argumentation is talking about corporate tax rates, and I can get into that now if you'd like me to.
Go for it.
Okay, sweet. So I'm going to be examining that through 4 observations, actually. The first observation is really looking at the plan as a whole, because I've heard argumentation a lot about how this is going to increase the deficit dramatically. Now, I don't think the deficit should be increased. Obviously, both of us can agree larger deficit is objectively a bad thing. But my first observation you can write down is lower taxes does not equal deficits. Again, lower taxes does not equal deficits. So say the government takes 50% of my taxes, and they're taking $1 million from me. So that means I earn $2 million. Obviously, I don't earn that, but I'm earning $2 million, and they're taking 50% of that, meaning that they have $1 million. Now the government spends $2 million, meaning that they have a deficit of $1 million. So say the government then reduces my taxes by 25%, the deficit goes up by 250%. The deficit goes up by $250,000, not percent.
Yeah.
So the way to solve this is not by keeping taxes higher and raising taxes to meet the government's out of control spending. It's to spend less. These are two separate issues. These are two separate line items. Let people keep their own money. Let them spend their money and keep their money and use it however they want, and just control your own spending. These are two separate things that need to be addressed separately. Obviously, I think the deficit should go down. Obviously, I think the government should control its spending. But the way to control spending and the way to reduce the deficit is not by raising taxes. And I'll be addressing again, furthering that inside of my later observation points a little bit later on. But just from a basic standpoint, we should let people keep their money instead of taking more of their money to pay for the government's out of control spending. My second observation is a story. It's not really it's not really a line of argumentation per se. It's a story that I'll expound upon later. So it's the story of Adam, Bill, and Carl. And I didn't write this myself. It came from a website, but it serves my purposes pretty well. So Adam, Bill, and Carl are 3 brothers. They have the same everything. They're all 3 married, and all have and all 3 of them have 2 kids, and they all make $25 an hour. Carl works 60 hours a week, Bill works 40 hours a week, and Adam works 20 hours a week. Carl's wife works full-time as a doctor and makes $50,000 a year. Bill's wife works part-time as a technician and makes $25,000 a year, and Adam's wife doesn't work. Adam and Bill both decide to spend their money and not invest and not save for retirement because they think they're going to get Social Security money. Carl and his wife save their money and invest it in stocks and bonds. Here's how all of their money turns out. Adam ends up making $25,000 a year. Bill makes $75,000 a year, and Carl makes $150,000 a year. A couple of years later, the 3 brothers decide to buy equally priced houses on the same street. After a while, the brothers decide that they're going to improve their street, by paving the road, just general gentrification of the area. And all of these repairs come out to about $30,000. Carl assumes that they'll split the bill 3 ways, and each brother will pay $10,000 each. But Adam and Bill get very angry at Carl and say, well, you make much more money than us. Why should we have to pay the same amount as you because you make so much more money than us? How is that fair? Bill realized that their combined income is $250,000. If they take 12% of all of their incomes and pool it into that, they'd be able to pay off the $30,000. So a flat rate would be able to pay off the $30,000. Here's how it would turn out. Adam would pay $3,000, Bill would pay $9,000, and Carl would end up paying $18,000. But then Adam has an even better idea. How about Carl pays $23,450, Bill pays $6,550, and I, Adam, pay absolutely nothing? Carl is incensed and outraged. He's paying close to 80% of the bill despite receiving the exact same benefits as everybody else. Bill thinks that the concept is a little unfair and arbitrary, but he stays quiet because he's saving $2,000 underneath Adam's plan. Carl asks Adam where he's getting this arbitrary plan from, and Adam responds with the IRS tax tables. This is how taxation in America works right now. Corporations and the 1% are hammered under the pretense that it saves money and reduces taxes for the lower and middle class. And I'm going to be examining why that's a bad thing instead of my last two observation points. I know this is a little bit drawn out, but sorry about that. My last two observation points. Observation 3 is that the 1% stimulates the economy. Again, observation 3, the 1% stimulates the economy. The 1% is where innovation happens. It's who pays your salary. It's who, but the government continuously hammers the upper class under the false assumption that they're objectively evil and do bad things. And we need to lower taxes for the middle and lower classes. But if we lower tax rates on the upper class, it opens doors for more innovation and for raises for people that are working in the middle and lower classes. And then my fourth observation sort of ties into that one, which is that lowering rates on the 1% will fuel the economy. Some families haven't seen raises in decades under the current system. America has some of the highest corporate tax rates in the entire world, and it is in turn harming the middle and lower classes. And I'll expand on that obviously a little bit more. This is just sort of rudimentary argumentation. There's a lot to talk about inside of this, but I'll pass it back to you and see your responses.
Okay, so I guess the first thing when you're saying lower tax rates does not equal deficits, I think what your answer to say cut spending, it's predicated on the idea that the spending is a movable thing which can be cut. So I think what you have to realize is that there's a lot of spending the government does which is actually kind of non-negotiable. So for example, you could say, well, look, Medicaid, there's a lot of money in there, maybe we should cut it. But then the consequence of that happening is that lots of people then go without medicine and die. You could say that, well, look, the military budget's pretty bloated, maybe we should cut that. And the consequence is that the US opens itself up to, it begins to look weaker in the eyes of the world, and that causes problems, like increased terrorism and things like that. So saying that lower taxes does not equal deficit is contingent on you showing that there is a real area of equal magnitude which would not cause other problems if it was, when it is cut instead. It's a zero-sum game pretty much. So I would say that you shouldn't lower taxes unnecessarily on the idea that you'll find the money somewhere, because you probably won't. The story of the three brothers is basically just an argument in favor of a flat tax against a progressive tax. First thing the first thing is that if you think that a flat tax is correct, then you shouldn't like this bill because it's not a flat tax. Like I get that it's slightly less progressive, but it's a far throw away from the perfect world which you envisage in the Three Brothers story. But secondly, I actually think that the progressive tax system has got it right. And the reason for that is that the story of the Three Brothers is a little bit misleading, because the brothers actually aren't all that different in terms of their income. Like, I get that there are differences, but in reality, what the progressive tax system addresses is people who are paying, who earn like 10 grand a year, being taxed less than people who earn 100 grand or even $1 million a year. And the reason which that's fairer is because even though in theory, yes, you're right, a flat tax would have the same percentage of their income, percentage of income does not equal an equal sacrifice on their part. So you can imagine, for example, I don't know what tax bracket you're in, but if I was to take away half of all of your money, that would probably represent you having to make sacrifices in your life on your part, right? Like, because half of your money is not disposable income. You would have to, cut back on your quality of life. That would be bad. Whereas if I was to tax Donald Trump for half of his money, that guy's sitting on half of his money, right? Like, it doesn't actually mean anything for him in terms of quality of life cuts. So if you want to say that, so I guess the problem with the Three Brothers story is that one, the Republican plan doesn't even make the standard you're setting yourself, but also even if it did, it's actually not a fair standard anyway. The third thing you talked about was the 1% pay bills to stimulate the economy, which is predicated on the idea that basically the rich have a certain it's like they have a certain quota amount of money which they have to keep for themselves, and anything they receive beyond that immediately gets reinvested. The problem with that is that it's not the reason you invest. And unfortunately they have a fiduciary duty, which is a legal obligation to their shareholders not to. So what you want to happen is to give these people tax breaks, and then for that tax to go into new investments which they otherwise wouldn't have done. The reason that's not going to happen is twofold. One, if those investments were good, they would be doing them now anyway, right? Because they can lend money to make investments, right? If it was actually a good investment, then they could borrow, and then the returns on the investment would outpace the interest on the loan. But there's not like, if they just get given money now, it's not like they pour their money into bad investments just because they've got the money. And in fact, they are legally obliged not to if they're a publicly traded company of shareholders. So unfortunately, that's just kind of not how it works. The fourth thing you're talking about was that America has the highest corporate tax rate, or has higher. I guess the problem there is, again, is that it's presuming that if America is kind of in the middle of the pack, then people will go to it. But again, the fiduciary duty kicks in here. These companies have a legal obligation to go not just to kind of somewhere amongst, not the highest. They have the responsibility to go to the lowest tax bracket. So unless you're going to lower your corporate tax rate to lower than like Panama or Northern Ireland, then you're not going to get any of that business back, because it's just a comparative, right? They go to where the tax rate is lowest. I get that now America isn't, it's like not the worst option, it's like the fifth worst option. But that's not like the companies don't go, oh, that's all right then, we'll just go to the fifth worst option. No, they always go for the best option. So, and the Republican plan doesn't do that. So by your own metrics, it seems like the Republican plan doesn't actually change any behavior in the real sense of the word, which suggests that it's not good policy. So yeah, why don't we go back and forth on one of these subpoints each? Do you have any opening thoughts about any of them?
Hold on, I'll go back to them and look at them over again. As I look at them, I mean, after I move on opening points, I'd like to respond to a couple of things you said, obviously, but I don't have anything as in depth as what I talked about on that first one. I'll probably talk about how it removes the state tax deductibility. Just basic rudimentary argumentation. That is a good.
Before we go into state taxes, do we maybe want to discuss just a few of the reasons why this corporate tax cut might be good or bad, and then we'll do state taxes afterwards?
Yeah, that'd probably be for that. That'd probably be for the better. Because I do have a couple additional lines of argumentation to bring up here inside of this. A couple empirical cases, and then an economic principle, which might take up a little bit more of our time. Hold on, let me get to that real quick. So I'll move into the three empirical cases that respond to a lot of the things that you brought up as a whole. Looking at why lowering taxes on the upper class and on the 1% overall is better for everybody else, and how it stimulates the economy. I'll just tell you them right now. The first one is of the 1920 tax cuts, the Kennedy tax cuts, and the Reagan tax cuts. So let's first start with the tax cuts of 1920. Tax rates were slashed dramatically during the 1920s, dropping from over 70% to less than 25%. What happened? Personal income tax revenues increased substantially during the 1920s. This is quoting from a website, by the way. I didn't write this myself. I can post it in the comment section as well. Despite the reduction in rates, revenues rose from 719 million in 1921 to 1,164 million in 1928, an increase of more than 61%. According to then Treasury Secretary Andrew Mellon, quote, "The history of taxation shows that taxes which are inherently excessive are not paid. The high rates inevitably put pressure on taxpayers to withdraw his capital from productive business and invest in tax-exempt securities, or to find other lawful methods of avoiding the realization of taxable income. The result is that sources of taxation are drying up. Wealth is failing to carry its share of the tax burden, and capital is being diverted into channels which yield neither revenue to the government nor profits to the people." The second one is of the Kennedy tax cuts. President Hoover dramatically increased tax rates in the 1930s, and President Roosevelt compounded the damage by pushing marginal tax rates to more than 90%. Recognizing that high taxes were hindering the economy, President Kennedy proposed across-the-board tax rate reductions that reduced the top tax rate more than 90% down to 70%. What happened? Revenues climbed from 94 billion in 1961 to 153 billion in 1968, an increase of 62%, well, 33% after adjusting for inflation. To quote from President John F. Kennedy himself, quote, our true choice is not between tax reductions on the one hand and the avoidance of large federal deficits on the other. It is increasingly clear that no matter what party is in power, so long as our national security needs to keep raising, an economy hampered by restrictive tax rates will never produce enough revenues to balance our budget, just as it will never produce enough jobs or enough profits. In short, it is paradoxical that the tax rates are too high today and tax revenues are too low, and the soundest way to raise the revenues in the long run is to cut the rates now. And then finally, I'll go through the Reagan tax cuts pretty quickly. Thanks to bracket creep, the inflation of the 1970s pushed millions of taxpayers into higher tax brackets, even though their inflation-adjusted incomes were not rising. To help offset this tax increase and also improve incentives to work, save, and invest, President Reagan proposed sweeping tax rate reductions during the 1980s. What happened? Total tax revenues climbed by 99.4% during the 1980s, and the results are even more impressive when looking at what happened to the personal income tax revenues. Once the economy received an unambiguous tax cut in January 1983, income tax revenues climbed dramatically, increasing by more than 54% in 1989. According to then United States Representative Jack Kemp, a Republican from New York, one of the chief architects of the Reagan tax cuts, he said, quote, at some point, additional taxes so discourage the activity being taxed, such as working or investing, that they yield less revenue rather than more. There are, after all, two rates that yield the same amount of revenue: high tax rates on low production or low rates on high production. And that leads me into my economic principle, which is looking for the golden standard of tax rate. What is the perfect rate to tax somebody? And it's of the Lauer curve. I'm not sure if I'm saying it right. I'm not talking about Matt Lauer. I'm talking about it's an economic principle, and I'll show it to the camera right now. It looks something like this. You've probably heard of it if you know economics. And what it shows is that obviously if you tax somebody 0% of their income, you make $0. The government will make $0. So if you tax more, you're going to be making more money. But following diminishing returns, if you tax somebody 100% of their income, they're just going to stop working. So you're not going to be making any money. The problem, and this is what people have been debating for generations, is to find that golden spot on the Lauer curve. What is the exact peak of that? And that's what all of this is talking about, and all of the applications that I'm talking about. If you have high tax rates on corporations, and if you have high tax rates on anybody, they're just going to be looking for opportunities to get out of those tax rates. That's why we see so many slashes inside of the Republican tax plans to weigh on ways that the top 1% and middle class families can reduce their taxes. Because they're lowering it on the 1%, they're also taking away ways for that 1% to reduce those taxes. Because that's why we see a lot of people that if you saw the debates, they asked Donald Trump if he paid his taxes, and he kind of avoided the question, and then he went, well, that makes me smart. And that happens in every single corporation across the country. Because taxes are so insanely high, they will go to any lengths to reduce those taxes and do insane things to get those taxes down and manipulate the system and game the thing as a whole. So that sort of responds to a lot of things that you talked about. Those quotes from all of those pretty credible people. I quoted a president that talked about taxation as a whole. That sort of responds to a lot of stuff that you were talking about how tax rates, deficits, and how lowering tax rates on the 1% doesn't stimulate the economy. But I'll go line by line down the four things that you talked about and respond to those very quickly, and then I'll pass it back to you. I know I've talked for a long time. I'm really sorry about that, but I'll just pass those back to you. And you talked about how there's a spending cut, and how there's a lot of things that are currently in the U.S. budget that's currently non-negotiable. Overall, I'd agree with that. There's a lot of things that we shouldn't cut. Like social, like a lot of things that military spending. It's kind of iffy, to cut that. There's a lot of things that shouldn't be cut, but there's also a lot of things in the United States budget that should be cut. I'm doing something for team policy where we have to look at the Highway Trust Fund. They spend a lot of money on stuff like squirrel sanctuaries. There's a lot of little things that compound into large things in the U.S. government that should be almost completely cut. Funding for NASA, EPA, transportation. These are things that are also unconstitutional that the government shouldn't be paying for, that takes up a massive amount of their budget that really shouldn't even exist in the first place, because of, one, it's taking up a lot of money, it's increasing the deficit, and two, it is borderline unconstitutional in a lot of cases. looking at the second thing that you talked about how I'm advocating for a flat tax, I'd agree that that did get a little bit confusing in the story that I brought up. I agree that the Republican plan is not a flat tax. The one thing that I really want to look at inside of this story is the part where it talks about how Bill went from $9,000 having to pay $9,000 for the street to $6,550, where Carl's tax rate went up. I'm not saying that a tax rate is a good thing. What I am a flat tax is a good thing. We're not talking about that. What I am saying is that increasing the taxes on the richer people in order to lower taxes for the middle class is overall not acceptable. For again, the third and fourth observation and those quotes that I brought up, it doesn't do good things for the economy. It overall ends up hurting a lot of people. And then talking about and you also brought up a sub point underneath this. About how it would be hurting the lower and middle class. I'm not saying that the lower class should be paying taxes. I don't think that that should be a thing that happens. I agree that there are some aspects to the progressive plan that are a good thing. That's why I like the Republican tax plan as a whole, because it's not so far to the right that it's just insanely unfair to people that are in the lower tax bracket, but it's not so far to the left that it's insanely unfair to the people in the upper tax bracket. It's right in the middle. It's a good mix between progressive and conservative, and overall, it's the best tax plan that has been presented thus far. And then looking at the third thing that you talked about is talking about how the companies would more than likely keep this money for themselves, and how that there isn't a certain quota that they keep for themselves and then they don't invest it into companies. My response to this is that they have to keep moving forward. Again, have to keep moving forward. There's a saying in business that if you're stagnant, you're going backwards. So it's not like these companies are just going to stop investing into their company and stop giving raises to their employees. During the Reagan administration, families got raises on the regular basis because companies were investing back into them because the corporate tax rates were dramatically slashed. It's not like these companies are just going to keep all of this money for themselves. That's overall not financially or economically lucrative to them. They're going to invest it back into their company, grow their business more, which will eventually yield more profits for them. So overall, I think that the Republican tax plan is a good thing. Sorry for talking so long.
That's all good. So look, I'm just going to go through a few of these things. The first one was about if the corporations would spend more of the money. You're aware that inflation is currently very low, right? I'm going to try to get it back and forth. It's like it's quite low at the moment.
I'm not aware of compared to historically. I've always thought that it was pretty high, but I'm not actually aware of that.
Okay, I'll just look up the current inflation rate. So are you familiar with how you don't actually have to have capital to make investments? You just need to be able to loan the capital to make an investment.
Yeah, I am aware of that. Yes.
Yeah. So basically, if there was a good investment out there to be made, that companies, they don't need to be taxed less. They could just loan the money and then make the investment, right? The only difference is that you'll just lose the interest rate on the loan you would make. Does that sound fair enough?
Okay. Yeah. Yeah.
Yeah. So what that means is that, and companies also, as you said, can't be stagnant. They have a fiduciary duty, which is a legal obligation to make as much money as they can. So you would have to point to all of these investments which are currently not being made when they could just be made by loaning money. So does that make sense? How it doesn't necessarily follow that just giving them more money in the form of a tax cut would lead to more investment, because that investment would already be happening if it was
Yeah,
profitable.
I see the point that you're trying to make, but my main line of argumentation wasn't necessarily talking about investments. It was talking about incentivizing their own workers to work harder by giving them raises and investing it back into their own company. So I mean, investments in the sense that like paying your employees. I would argue that you can't like give your employees an IOU. You have to have physical money to pay them. So investments in the sense like taking a loan out of the bank or something. You don't have to have capital to do that, but you do have to have capital to pay your employees.
Okay, so hang on. So, but you said that. So you're saying that if you pay your workers more, then they work harder. So if the amount which they work harder outpaces the interest on the loan, which is very low because the inflation rate is very low at the moment, then they would do that now anyway. It's just at the end of the day, like workers don't work that much harder just because you pay them more. Like does that make sense, right? Like in that case, if you thought that was the case, right, then you would actually want the government to just put the minimum wage really, really high, because it would mean all the workers would work harder and things would be more productive. So that point doesn't really make any sense, because you just loan the money and pay them more, and then the amount which their increased productivity would then use to pay back the loan and you make money.
I'm not sure if I mean I'm not that into economics. Like I feel like you probably know a lot more about this than I do, but I'm still sort of not entirely understanding what you're saying. I don't feel
Okay,
like you can sort of give your
sorry.
employees.
Yeah, no. I'm a mathematician. So
Okay.
what you're saying is that you would make money to invest in your workers because you pay them more, so that's your cost. But then their
Okay.
increased productivity then yields you benefit. What I'm saying is, if the benefit it is yielding you outpaces the interest on your loan, then it is a matter of simple arbitrage to just loan money and then pay the workers, and the increased productivity you get pays back the loan and you yield profits. Does that make sense?
That okay. That makes sense now, but we're not
Yeah.
seeing that happening though.
Yeah. So what I'm saying is that the reason we're not seeing that happening is because the premise you are relying on is wrong. Paying workers more does not automatically lead to increased productivity. And you've given really no reason why that's the case. Are the workers just like happier, and so they're like, "Whoopee, I'm gonna." Do you know what I mean? Like
Hmm.
at the end of the day, the work a lot of workers work as hard as they can because of things like job security. There are lots of other people who are fighting for their job, who are promising to work harder. There are lots of competitors overseas, for example, who work really hard for next to nothing. So, yeah, I just think the premise, if the premise is true, that just in raising wages leads to meaningful growth in work productivity and therefore profits, then you would see businesses loaning money and doing that, but they're not doing that. So the premise is wrong, which means that you're not going to get any growth. Does that kind of make sense?
Yeah, that does make sense, but I'd also like I'll do this very briefly because I've talked for a long time. I'll direct you back to the 3 points that I talked about.
I'm going to
So,
get to them. I'm going to get to them.
okay,
I
yeah,
promise.
I'm sure that you
Yeah.
were gonna
But I'm
get to
just
that,
trying to go
but
one
yeah,
by one, right? Like that one's important because if
yeah.
that's not true, then you're not getting any increased investments or even raised wages. So I'll go to a few of the other ones. The next one you were talking about was about a few empirical examples. So with Reagan, for
Mhm.
example, the reason which Reagan and you talked about this in your speech. Weird that you didn't hear the difference, right? When inflation goes up, it means the tax rate is unfair, not because the rate's unfair. It's because the rate's unfair in the context of high inflation. Like in the 1920s, inflation was at 15%. And the reason for that was because at the time, in the pre-Thatcher Reagan era, there was full employment was a target, which when there's full employment, workers can threaten to leave for another employer because there is always that option. And so their wages have to get higher and higher and higher, which means that your income tax starts to become unrepresentative of what the wages are actually worth, right? So that's correcting for an inflation problem which doesn't exist right now. And what made the economy go well, right, when Reagan fixed it, wasn't the fact that the taxes went down. It was actually more to do with the way in which they started controlling inflation because it made more price stability. So if you could imagine, for example, when inflation is going up and up and up, like 15% higher as they were doing back then, if you make an investment, that's a bad idea. Because say I loan $100 expecting to get $120 return, but if inflation has outgrown, so my $120 return is now worth less than my initial $100, and there's no reason to make an investment. That's got nothing to do with taxes. That's just an inflation problem. So that's why that one's irrelevant. The other one you talked about, which was that the normal top marginal tax rate was 90% and it lowered to 70% and great things happened. That would infer that maybe 70% is a good tax rate, but not that 20%, which is what the current plan is as a good tax rate. And you actually pointed to this when you talked to your curve, right? You were saying that if it's on either extreme, it's not great. When it's kind of in the middle, it's good. So 70% is kind of like the middle. Like if you were to do like mathematical standard deviations, 70% is 20% higher than 50. So it's and 30%, which is what the pre-tax plan one is 20% lower than 50. So they're kind of in the same range. Whereas what you're suggesting is actually to push it in the extreme low when you already told me the extreme high was bad. So what you've proven is that the extremes are bad, and you've also admitted that this policy pushes it to the extremes. The other thing you're talking about is if the tax cuts are really, really high. So if the taxes are high, then people don't want to pay them. Again, companies have a fiduciary duty to just go to where the lowest tax rate is, regardless of how high it is. So, or how, because at the end of the day, people want to make money no matter what, right? Like companies are legally bound, responsible to make money for their shareholders. So it's not like, Trump was, saying, well, maybe if the tax rate was 20%, that I would have just poured millions of my dollars into the government. No, he has a job to do to make money for his company, and that is to go to the areas of the lowest tax burdens. So making the US's slightly lower doesn't make it the lowest. So it doesn't change any of those incentives. So for example, like, Apple's effective tax rate is less than 10%. Apple's not going to start paying like more than a 15% increase on their taxes just because it's now a little bit, just because it's not a 25% increase on their taxes. So I think the basic problem with this argument is that the reasons they are doing what they are doing now are the same after this tax plan, because they're still going to save money by not paying taxes. They're still going to save money by not making the sorts of risky investments. They're still going to save money by fleeing to smaller tax havens. So you've given me no reason why any of those things will change.
Okay. I'm going to briefly respond to a couple of things that you brought up, and then we can move on from this and talk about other things, because I feel like we talked about this quite a bit, if you want to. But I'll briefly respond to a couple of things that you brought up. Looking at the Reagan thing, I have two separate responses to why this is still relevant. The first one is that it wasn't just inflation that caused the tax rates to be an issue. In fact, I talked about this at the start. It was partially bracket creep, which was something that pushed a lot of lower income people into an upper part of the tax bracket, and it made it hard for them to actually earn money and do things because they were getting taxed at a higher rate. So this tax plan reduced.
The bracket creep was because of what? Inflation. Because
in part, yes.
Yeah. No, not in part. That was it. Like, the reason they suddenly started looked like they were earning more money, even though in real terms their wealth didn't change, was precisely because of inflation. There wasn't any other reason.
Okay. And then that sort of leads me into my second response. Even if it does have to do with inflation, there was still growth when adjusted for inflation. And it talked about this inside of the article. There was still a 33% growth. Originally I said 62%, but even when adjusted for inflation, compared into today's terms, there was still a 33% growth when adjusted for inflation. Again, I'll post this underneath.
Again, you're confusing terms. Adjusted for inflation just means that if you were to take the growth figures and then and like evaluate them not as just that amount of money, but allow for the fact that that money is now worth more in today's terms. That's what adjusted for inflation means. That's very different to a huge change in monetary policy. I get that the word inflation appears in both cases, but they are completely distinct things. So when it says adjusted for inflation, that doesn't mean ignoring all of the monetary policy of the Reagan. So yeah, that's it. That's just I mean, it's a poorly named term. I agree, but they're different things.
Okay, I guess we'll move on from that and look at the curve argument that you made about how I'm pushing it to the extreme, to the sort of the left side of the extreme, and we don't need to be doing that. But my response to this is that we're assuming where the golden spot on the curve is. So we're assuming, based on how normal math works, that the golden spot would obviously be 50%. That's how normal math works. That's obviously not the case with taxation. We have no idea where the golden spot on the curve is right now. So 20% very well could be, that golden spot on the curve. That's, the reason why it's so unpredictable is because it changes over time. Back in history, as we've seen through these examples, 60% was a good tax rate back then, but it's obvious now that, a lower tax rate is not a good thing. So we don't really know where the golden spot on the Lauer curve is. It changes over time.
Would you say on this that probabilistically the golden spot is more likely to be in the extremes or in the center?
I'd say that they'd more likely be in the center, but we've seen historically that that's not always the case. Look at the example of the Reagan tax cut. 70%, I'd argue, is decently close to the extreme. Obviously, looking at what you talked about, it's only 20% more than 50, but it's closer to the extreme than straight up on 50.
Yeah, but if you think that it's truly unpredictable and that we don't know where it is, then why would you go in the direction which is, as you said, probabilistically less likely to be the golden spot?
I'm not saying that it's completely unpredictable. I'm saying that there is, generally speaking, it's going to be closer towards the middle.
Yeah.
But as times change and as people, the economy changes, and you talked about inflation, as that changes, the Lauer curve will move. It could very well be an extreme. Probably, likely, in all likelihood, it's not. But it changes over time. It could be 20%. It could be 80%. We have no idea.
But this policy is pushing it to the extreme, which you just said in all likelihood it's not. Like, do you get why this is an issue, right? Is that if you
I understand what you're trying to say, but
then you would go.
Yeah, I understand what you're trying.
Yeah.
I get what you're trying to say, but that's closer towards the middle, and obviously that's not where it is. So why not push it towards the extreme and see if that's actually where the golden spot on the curve for this point in the economy is? You see what I'm trying to say? Like it's obviously not closer to the middle because we've had it in the middle, and that's not a good thing for these corporations right now. They're getting
30%
hammered in taxes.
Like 30,
It's 35%,
35. Like,
but yeah,
you know what I mean? Like by that logic, you could just push it to 65, and the same thing would happen. You know, you'd like the logic you're using would also justify bumping the corporate tax rate to 65%, because you'd say, well, it's not working now.
I understand what you're saying. Yeah. But like that's still the argument that I'm making, that it's unpredictable. We know that it's not towards, you know, the middle sort of extreme. So why not push it a little bit lower and see if that's actually where it is? You know, in
Well,
all
you don't know
likelihood,
that's
looking
not
at it from a
like you've never tried 60, you've never tried 65% today, so you don't know it's there. If anything, another good reason to suggest that you shouldn't try the lower extreme is that it causes a whole lot of debt and deficit problems. So if you're going to try something which hasn't been tried before today, you might as well go for 65%, pay off some of that debt, and then if it doesn't work, then try the lower extreme. But if from your position you're just stabbing into the dark, it seems weird that you would stab into the dark at a position which leaves the country in a lot of debt. Do you know what I mean? Like,
yeah, and I get what you're saying, but that's also why I brought up the argument about how lowering taxes does not increase deficits. And I brought up the response to something that you talked about. Talking about, hold on, what was your
oh yeah, I know.
response?
You were talking about
Sorry,
how squirrel sanctuaries and NASA are a waste of money. I mean, look,
oh yeah, yeah.
I would just say that if you were to cut those things, you wouldn't pay for this corporate tax rate cut, because it's just so huge. You'd have to cut a lot more. And by the way, NASA, like, you know, sure, maybe you cut NASA, but then what are you going to do if the Chinese space program discovers like a new fuel or something? You know, then you're really behind. Like, there's a reason America got into the space race, and it's not just about in case you discover the golden fuel or whatever it is. It's also it's like a national superiority thing, and it's about showing the world that America is on the cutting edge of tech and of those. Do you know what I mean? So it's like those cuts, like those cuts might hurt more than you think. So, and they're not even going to pay for the corporate tax rate.
Okay, I couldn't find the Department of Transportation. I have it somewhere.
Mm.
I've spent all this year in team policy looking over the Department of Transportation, and also looking at the EPA. I wasn't just talking about squirrel sanctuaries. That was just one example. There's a lot of things inside of the government's budget, little things that compound into larger things. I have something in like a binder that probably have to spend like 3 minutes looking for, about how much waste is actually in the federal government, but about like 30 to 40% of our spending in the government is wasteful, that could be cut and could pay for a lot of
Well,
things.
out of interest, why not just cut the waste and then pay back the debt instead of lowering? Because if you say, well, I know
That's my argument. I'm saying that they're two separate line items. That cutting the deficit doesn't mean that we shouldn't let people keep their money. That's my argument. That yes, we should let people keep their money because that's a separate good thing. But at the same time, we should also cut the deficit because that's also a separate good thing. That's the main argument that I'm making. They're two separate line items that shouldn't be considered the same thing.
Well, except that they're all on the same balance sheet at the end of the day. Like what I'm saying is that if you know for certain that cutting a whole lot of wasteful spending saves you money, and that we both know that the government is in deficit and in a lot of debt, which has to get paid back because otherwise you're accruing interest on it, and that's not good. Why not go for the certain line item number one and wipe away the debt and deficit? Then you can have a conversation once you're in surplus about cutting corporate tax rates, because you've actually got money to spare, right? Like in Australia, for example, when at a point in time where our government, and it was a right wing government, most viciously cut taxes, was at a time where we were in surplus, right? Like there was actually money to spare. It seems weird that you would. Well, it's basically gambling. Like if you're in debt and you're gambling on a tax rate, which, as you kind of already admit, is a bit of a stab in the dark as to where the Goldilocks zone is anyway. That just seems like irresponsible tax policy to me. Seems that you should just keep the tax rate where it is, cut the wasteful spending, and pay back the debt.
Okay. I'd just like to sort of direct us back to a lot of things that I've said before.
Actually, just one thing. We only have 50
Yeah.
seconds left. Do you want to continue on a few of the other, like this one, you could probably just rename to like Ben and Henry discuss corporate tax rates. Do we want to maybe do you want to chuck up another one and talk about one of the other issues? Because I feel like we might have come to loggerheads on this issue. Not that it hasn't been a good discussion, but we might have exhausted the productivity of this one.
I'm not sure if there's like I feel like we'll end up sort of in the same place that we did with this one on literally any other discussion. I could probably talk about.
I have a feeling not. I've got a good one about the deduction for state and local taxes. I reckon you'll like it.
All right, all right. We could probably work. We could probably do another one. We'll probably shorten it. I don't think we'll be able to spend like 45 minutes on that because I don't have as much to talk about on the other ones.
Okay.
This is really the main thing that I prepared for, but we can talk about all the other things.